Will you like to pull up General Dynamics?
Yes.
People seem to be interested. GD is one of the best big defense contractors. So, yeah, let's get after it. What is the ticker symbol for General Dynamics?
GD.
GD. Let's go for it, baby. What's the market cap?
$44 billion market cap. 14 PE. Check mark.
Very nice.
8.84% profit margin. X, but I thought that was going to be the case. We looked at Lockheed Martin. I don't think they had a big profit margin either, so this doesn't surprise me at all. 2.9% dividend yield, which is roughly 1.3 billion, I don't know, $1.3 billion in dividends a year.
Nice 3% dividend. Okay. How about pillar number 3 is revenue growth over the past 5 years, Paul?
Okay, revenue growth. Now remember, guys, new administration in, Democrats tend to be less pro-military. Who knows if that actually happens? I think both parties the same, but that's something to consider. 31.78 billion to 39 billion. Check mark there.
Profit growth over the past 5 years, Paul. Profit, we went going up, of course.
3 billion to 3.48 billion. So basically 3.5 billion. Check mark there.
Pillar number 5 is number of shares outstanding. We want these going down and not up.
321 to 288. Check
Very
mark
nice.
there.
Good stuff. Pillar number 6, current assets greater than current liabilities.
So current assets on hand are 21 billion. Sorry, 21 billion right there. Current liabilities are 16.1, so $5 billion extra. That's great. But total liabilities is 35.5, so they don't have enough cash to pay off their liabilities. But it's still a check mark.
Still a check. Pillar number 7 is free cash flow growth, Paul.
All right, let's do this. You ready? 2 billion. 2 billion.
Okay, on that one I can handle.
Check mark there. 1.75, 3.4, and 2.6.
Okay, the free cash flow average over the past 5 years is 2.3, Paul.
So it's not going much places in terms of this free cash flow. The revenue is going up slightly. I think there was a couple acquisitions in there. Acquisitions, yeah, big acquisition there at 10 billion. I'm going to multiply this by high side 15. That is $34.5 billion. I think it's the high side of what you pay for that company.
Market cap is $44 billion.
So it needs to go down by 20%, 25%. Yeah, I think with the contractors, with government contractors, it's too up and down based on what the government's doing at that time. I mean, they made a big acquisition here, $10 billion acquisition in 2018. I don't know. That's a good question. So let's see. They did 39.35 in 2019. In the last 12 months, they've done 38. So their revenue is already down in the last 12 months, and it was. Now, I'm sure a lot had to do with COVID, but revenue is still down. So you have to wonder how they're going to get that number. I'd be buying maybe even lower than 35 billion. Maybe it's got to be like sub 30 billion just to be safe. I don't really look at return on equity as much. It's a big thing for Buffett back in the day. I don't know if that's the same anymore because you can really manipulate the equity in a company with shares and all that stuff. And in terms of Ebitda, I don't look at Ebitda as much as I look at EBIT, earnings before interest and taxes, because I think depreciation, except for real estate, is a real expense. And people like to look at it as like, oh, it's just depreciation. No, that's why I look at free cash flow after capital expenditures. You get the depreciation from the capital expenditures. They're depreciated over long periods of time. So I look at EBIT, EBIT, more than EBITDA. I don't actually ever really look at EBITDA. And ROE is return on equity. Return on equity. It's basically the net income divided by the equity in the company. Buffett and them like to get 12, 15% return on equity. I don't really look at return on equity pretty much at all. I don't know why. I probably should, but I don't.